Hi there. Okay, this is going to be video number 76 and it's going to be video number 38 of module 3. This one's going to be a short video because this really is a no-brainer. Okay, we're going to be using the moving averages. Alright, now we briefly explained using moving averages in another video, but we're going to just use it in conjunction with the iMACD and only the iMACD. Okay. I also like to use this setup as well before I move on with the ADX indicator as well, and when the ADX lines up with the iMACD and it lines up with the moving averages, then it's a very powerful signal and you can use it on smaller time frames as well. Alright, so let's just get some rules out of the way first of all before we get in how to use the moving averages. There is the penetration technique that I've already mentioned before. I believe it was in the second module. With the moving averages, and that when you see the currency prices break above it, it's time to go long. When the prices break below, it's time to go short. But sometimes those signals are very short-lived, especially on smaller time frames, because there's a lot more movement happening on the smaller time frames. Those kind of breakout strategies do work a lot better on larger time frames because it allows you a little bit more time to see things play through. And you should be able to gain a fair amount of pips out of it. It doesn't always work out as well on larger time frames, but if, for instance, if you got in here where this was the break and it broke this blue line here, okay, which is the 12 exponential moving average, you could come in on the very next day and then wait 3 days to see what's happened. You can see that, the market, you could come back 3 days later and see that it's still more or less at break even, or you might be like 50 pips in deficit, which is to be expected of larger time frames. I have, on daily time frames, I've got stop losses up in the 500 pip range. Alright, because my balance can account for it. Alright, this is like an investment. Okay, it's not a game, although a lot of people do treat it as a game, and that's why a lot of people lose. Sometimes I treat it as a game. Sometimes I win, sometimes I lose. But if I'm going to put my investment head on, and I'm going to, if I'm really comfortable financially or whatever, or I'm comfortable with my life, I'm comfortable with myself, then I'm going to go ahead and I'm going to say, okay, I'm going to do this, that, and the other, and just see what pans out over a couple of weeks. I'm going to use proper money management, proper risk management, making sure I've got all my analysis, all my ducks in a row. Alright, and then I can go ahead and perform these longer term trades. But when you go into like these penetration techniques here, when the candles break above or below, you're not going to get that kind of satisfaction from waiting for an investment to mature on smaller time frames than you would on higher time frames. So yeah, for the most part, get used to using all of these strategies on lower time frames, and then just have that understanding that smaller time frames won't necessarily produce the same results as higher time frames, and more stable than the higher time frames. All right, so that's just one way that we could use. And then the second thing that we can use is when the moving averages cross over. This is another point. So when you see like the candles, okay, and you see like a moving average following up with it, and you got like another one that follows and it moves further away, and then you see the candles coming over, this could be your first exit point. If you got in long here, if you went long at that particular point and you got exited out of there, that's okay. But if you also need to take a look as well when you do your trading, is see where this point of where these two moving averages crossed and how far away it is from those candles, because you'll find that the further away these candles are from the crossover, the more short-lived your trade's going to be, and it's going to ask you to exit pretty soon, shortly afterwards. Alright, so we could use another one, like a third moving average as well, and then have that one line up with it as well. Alright, and then when you see 3 of them line up, regardless of how far the distance is, you'll find that there's going to be more movement out of that trade. Here's a beautiful example, and these are the kind of ones that I live for. Alright, that's absolutely beautiful. Alright, I can see that I've got my trigger signal happening there. It's almost a power trade. I can also see that the MACD line here and the signal line here are actually right at the beginning of the histogram like we've explained in other videos, which is what we're looking for, because the further the way that the MACD line and the trigger line happen in its own histogram, the least you're going to get out of it. The closer it is to the beginning, the more you're going to get out of it. Alright, it's a little bit like search engine optimization. When you keep having your keywords at the front of your title tag, description tag, and your domain name or your page of your name, the more you're going to get out of it. Alright, to a certain extent, at least anyway. Okay, so yeah, so that's what you got to really pay attention on. Now here is another area as well. We can see that this doesn't actually cross, but I call that a kiss, and a kiss is still a cross in my books. Alright, so when it touches or just barely sneaks on that moving average, and there's another one underneath, the red and blue lines together, right around here. When they cross over like that and actually penetrate through the actual candle while it's still being created, grab it. Those are really good trades. Now you've got to be very careful that the moving averages aren't too far away. There should really be no daylight. There's a little bit daylight in between there because I've just covered it with my red pen. Alright, but it does come down, and you know they're very, very close together. But when you see, like, let's see if we can find an example. Let's move some of this off. When you see like where it's crossed over here, and it actually happens on that bar there, you might have gone short on it and then panicked because it went back the other way and closed your trade out. Alright, so you've got to be careful with those ones. Alright, so be careful when you go for those crossovers. Alright, here is it's got two crossovers here, but it happens right very close to a load of candles, and also, which is an area that I wanted to touch on before really get into the main nitty gritty of these signals, is to ensure that this area lines up, tells you to go long. So it almost lines up. Actually, it might actually do line up, but there's only two of them that actually line up out of the three. We do get a little signal earlier. We might actually need to zoom in on that one. Let's take a look. Right, okay, well we only see two of these moving averages actually cross each other at any one time. Alright, we've got the green and the blue touch each other, and then shortly later we've got the red and blue that touch each other. So I'm going to get my crosshair tool out. I'm going to try and my vertical line tool out and get it to as close as I can to the MACD line where it crosses over here. And I'm having to again play within one bar either side. So that's fine. But in either case, if I put it over here, it lines up with the blue and green, and if I put it over here, it lines up with the red and blue. Alright, and then you go along on the next signal. On the next bar. But again, take a look, see where you're at. You know, zoom out sometimes if need be. You can see that, for instance, we've come from a downtrend, the 200 exponential moving average, and it's come back and it's hit this line once. This is an alert. Alright, it's to let you know that your trend, the trend is going to soon change. When you see it hit the second time, it will not either normally break it, or it will break it the third time round and then change. Alright, so that's kind of like your second alert. If you see it come back down like it does there, you know that there's going to be one more break up and above to come. This one doesn't really count because it's just poked its head out. Alright, you really want something where you've got a significant amount of data there that shows that you're definitely going to go the other way. Alright, and this one's actually changed trend again, and it's broke below, it's gone back up, it's broke down below again, it's gone back up, and it's broke for the third time, and then it's just dropped. Here was your warning. This one was a little bit different. We just got one warning here, and the next time it just broke. So, alright, so when we get these signals, alright, it's try and line them up. You see there's one here, so this is where you can actually use the moving averages on its own and go long, but only if you're using the moving averages, only use the moving averages when they all cross over at the same time. Don't use the moving averages when they're when only two of the lines match. Only do it when all three match. And I would like, if I can trust you, and if you was paid X amount of money and said like, okay, if you followed my strategy and did it this way, and if you break outside my strategy, you won't get 10 times whatever that's in front of you on the table. Let's say like there's 100 grand, right, and you'll only get 10 times that amount if you follow my strategies. If you don't, then For every time that you make a mistake or something, you know, $10,000 comes off that $100,000 pile, kind of thing. You know, to give you a bit of an incentive. All right, and you know, if you can see where I'm coming from, right? So you want to try and make sure that you always want to see that these lines always line up. Now, if you want even a better signal, is to wait for it to line up with the iMACD as well when they cross over. And that's basically a 30-second video that's been really explained into a 10-minute video, but I wanted to show you how to use the moving averages first. Also as well is take a look at the pattern. Can you see there's a pattern emerging here? Like basically like follow my neighbor kind of pattern. It's like, take a look at these currency prices, right? These candles. Do you notice something? Right, we're using exponential moving averages, and we know that exponential moving averages basically will follow as fast as it can to the current market price. But you'll notice that, you know, when we use this one here is a 24, this one's a 12. Now, if you notice, the 24 doesn't get hit that often. So if we went in short here, alright, and you can see that, you know, if it went sideways for a bit, it's come down and it's gone back up like that, and it's just basically hit that red line right there. Let's see if I can zoom in. Let's put a focus point in so I can come back to it if I lose my point, lose my spot. Okay, so if we went short here, alright, and it came down, and you think, yeah, okay, it's hit my TP because I'm on a support line. We're on a daily time frame. You got to say to yourself, well, okay, I probably could get more out of this because we're on a daily time frame. It's only been like 150 pips, so again, you'd move your stop loss down to break even, take off half position, and so on, so on, so on, so on. But you don't want to close it off when it hits that red line. You want to close it off when it breaks past that red line and closes off above that red line. All right, so you can see, look, it's coming down, it's making all of these retracements, these little retracements. And eventually, boom, it breaks it, hits it right there, and it closes above it. That will be your time to get out of the trade. So you could have got in here and got out there in about 2 weeks, 3 weeks, make 1,000 pips. Alright, okay, it's not going to happen every single time that you do it. Alright, but the object I'm trying to say is don't jump out of these trades too early. These moving averages are a very good indication on when to get out once you've got in a trade at the very beginning. Alright, you don't want to really get in a trade where, like, for instance, like here, I mean, the start of the trend is down the bottom here, and if you got in around about here, you would have been more or less okay to get out at around about here. You can see the red line gets hit there, so here to there, or it could have been here to there. Either way, you would have made a profit, I would have assumed, if you got in and acted on time. But you know, after a while, if you get it in at, I'm going to say, if you got in at around about, I don't know, around about here, so it's going to be one of these bars at the top, you can see that you're not going to really make that much from that when you're halfway through a trade, and or halfway through a trend, and you don't really want to get into these little sporadic ones. You want to try and find where they all line up at the same time. This one didn't. Alright, so, and these ones kind of did. So you would have got in very early, alright, and then take that trade all the way up. But again, you want to make sure that these are, you know, levering up and lining up as well at the same time. Alright, so there's a couple of ways that you can go ahead and use those moving averages. I mean, here is another one as well. Shows you there's a power trade, 2 moving averages actually line up, so that's still cool. Two moving averages. If you get all 3 moving averages lining up with the iMACD, that's great. If you see 3 moving averages line up, you know, all together on their own, but they don't line up with the iMACD, that's fine as well. You can still take that. Alright. Alright, there's only 2 there. And there you go. Well, that's give or take within 1 bar, so that's not too bad. Here's ones where they all line up together. And here's a bit of a power trade right there. Alright, so that'll be good. Alright, so there you go. There's the moving averages. Give that a go, see how you get on, and I will see you very soon in the next video. Alright, bye for now.